The stock market is hovering near record highs, but some of the most important warning signs are coming from places investors aren't watching closely enough. Joining me now is Kristina Hooper, Chief Market Strategist at Man Group. Kristina, great to have you back.
Great to be back. Thank you so much for having me.
So Kristina, everybody watches the S&P 500, but you say investors should really be paying closer attention to the bond market right now. What is it signaling that investors may be missing?
So I think what we're seeing is Treasury yields climbing higher on the long end and the shorter end. And we're also seeing a higher level of volatility. Now, why does this matter? Well, yields going up typically exerts downward pressure on stocks, particularly those higher valuation stocks, or what we would think of as longer duration assets. So it's important to recognize that we could see stocks come under pressure if yields go much higher. And then when it comes to bond volatility, typically when we see a big spike in bond volatility in the MOVE index, that can predict or presage some kind of stock market sell-off. The most blatant example was back in the global financial crisis, where we saw the MOVE index go up dramatically, bond volatility went up a lot, and we saw stocks, of course, come under enormous pressure. Something similar happened with the MOVE index in 2021, going into 2022, and of course, we know what happened to stocks then. So it's not a perfect indicator by any stretch of the imagination, but it can be a good indicator of what's going to happen in the stock market. And so I think we need to be paying attention to it, especially as stocks continue to move higher.
So what is the level on the 10-year yield, for example, that you're paying closest attention to? And at what level does it become a much bigger problem for stocks?
I think when the 10-year yield is at 5% or higher, that can be problematic. But we also have to keep in mind that a lot of it is about the level of the move higher. How many basis points does it move in how short a time frame? And that, of course, can also exert downward pressure on stocks.
We also have inflation that isn't exactly cooperating. PCE did come in line with expectations today, but inflation isn't moving in the right direction. So at what point does higher inflation become a real problem for stocks again? Because at this point, it seems like the market is sort of ignoring it.
Yeah, so higher inflation can be very problematic because it alters the Fed's trajectory. When we came into 2026, there was an expectation that the Fed would lean dovish, that we would see rate cuts. Now we're at the point where expectations are around rate hikes. That is a very, very big difference. And of course, if inflation runs hotter, appears more persistent, what we could see is expectations change again to more tightening. And we know what happened again in 2021, 2022. That was an extreme case. But when expectations are more dovish than what we get from the Fed, that can be problematic for stocks.
So we have inflation that's sticky, rates that are still elevated and could be moving higher. We have CEO confidence that's weakening, according to the Conference Board's latest data. Do you think that investors are underestimating how fragile the economy actually is beneath the surface?
I think so. Certainly, what we've seen is a fairly good economy, but it's really been driven by two key factors. One, of course, is AI CapEx spending, and the other is consumer spending, but largely high income consumer spending. About the top 10% of consumers in terms of income spend about 50%. Are responsible for about 50% of the spending. So that there's a vulnerability there, because if you have high income consumers who experience stock market losses or who experience job losses, that can change things. We've already seen them pull back a little on spending. And then, of course, with the AI CapEx spending juggernaut, that shows no signs of ending, but we could see some kind of a slowdown from a variety of factors, including a semiconductor shortage to inability to access adequate rare earth elements to support the big data center build out, to not in my backyard movements that are pushing back on AI data centers being built. So there are a number of reasons, or in fact, inability to raise enough money to fund additional AI capex. So there are a number of factors that could slow AI capex spending. So either key driver of economic growth could slow, and that could be very problematic.
Well, and you talked about higher rates actually hitting the higher valuation stocks. So what does that mean for some of the high flying stocks that we've been seeing really push this market higher? Do you think that there's still more room to run for those, or would you be getting cautious here?
Well, I certainly think there's more potential room to run, but I'm also cautious at the same time, recognizing that earnings have been very strong, and they could continue to be strong. But we have to recognize that as prices continue to move higher, as we see some multiple expansion, that means that there are more risks, there are more vulnerabilities. If we were to look, for example, at the Buffett indicator, which is the Wilshire 5000 market capitalization relative to US GDP, what we see is that it is now over 2 times. The Wilshire 5000 market cap is more than 2 times that of US GDP. Warren Buffett, a long time ago, warned that when you get over 2 times, that is a danger zone. There's more vulnerability there. So, yes, we could see earnings for a lot of the tech names, the high valuation names, continue to be positive in the next quarter, maybe a few more quarters. We have to recognize that there's vulnerability there. And if we see some kind of problem, if, for example, treasury yields go up a lot and exert downward pressure, or earnings don't meet such high expectations, we could see problems for tech names. When you're priced for perfection, if you don't have perfection, if you don't meet that standard, it can be problematic.
So if someone watching this says, okay, I hear the risks, but the market is still near highs and I don't want to miss out, how should they think about positioning in this environment?
I think it's all about being well diversified. So, for example, investors can continue to have exposure to the US stock market, continue to have exposure to the AI capex juggernaut, but perhaps diversify a little. Take some profits and put them in China tech, for example, or allocate to other parts of the stock market that they may be under allocated to. Some of the more value or higher quality names that are lower valuation, and also move abroad. There are a number of opportunities with lower valuations outside the US. And in particular, EM Asia is a bright spot right now. Well, emerging markets in general is a rather bright spot. You have those commodity exporting countries that are benefiting from higher oil prices. And then, of course, you have Asia EM that is benefiting from the AI capex build out, not just in the US, but in China.
Okay, so making the case for investing internationally, how should investors be thinking about playing defense if they think, okay, the market's run a bit too far, too fast for my liking, I want to play defense a bit more? What are some ways that they can do that to not miss out on the gains, but also to protect themselves if there is downside?
Yeah, I think it's all about being well diversified and also having some exposure to alternatives. There are a number of different alternative strategies, like market neutral strategies, that can enable investors to participate, to protect. And so I think, again, that being that well diversified and not just within equity and fixed income, but also having exposure to alternatives, lower correlating assets within the alternative space can help complement a portfolio and has historically smoothed out some volatility.
You talked about the consumer weakness that we've been seeing, especially at the lower end. What sectors or trades are most exposed if the consumer finally cracks?
Well, I think that it's consumer discretionary, and particular consumer discretionary that is lower and middle income primarily driven. So what we've seen, in fact, is, as I said, higher income consumers doing the vast majority of the spending, that could continue and be exacerbated in the near term. So there are a number of consumer discretionary names that are already under pressure. But if we were to see a bigger collapse in consumer spending, consumer discretionary in general would be hit hard in this environment. And of course, we do have some valuations that are more extended in the consumer discretionary space. But I think if we look more broadly, we have to recognize that it's not just about consumers that could be under pressure. We could see companies under pressure. We're seeing oil prices that are much higher than at the start of this year. And we're also seeing the impact on other important commodities. Their prices have gone up. It's not just oil that passes through the Strait of Hormuz. A significant portion of the global supply of commodities such as urea, ammonia, and helium, which goes into semiconductor manufacturing, all those commodities are going to see their prices go up quite significantly. That's going to impact the bottom line for a number of companies in a variety of different industries.
Okay, so another risk that you're laying out there. So is it easier to make the case that this is a market that moves higher or lower from here?
Well, it could certainly move higher in the shorter term, but I do think, and valuations are not predictive in the short term. So I will say though that they can be very predictive in the longer term. And what we see are very extended valuations and the potential for disappointment. So I think it could easily move higher in the shorter term. We have catalysts that could move it higher, like an Iran-U.S. peace deal. But I do think at some point this year we will see disappointment.
What would that disappointment look like? How big of a pullback could we see? And would that ultimately be a buying opportunity?
So I think we could see a 10 to 20% pullback in this kind of market environment. Keep in mind, we have seen just enormous gains made in a relatively short period of time. And so it really depends on what we see taking shape in terms of the longer term earnings picture when we see that pullback. But it could very well represent a buying opportunity for investors with a long enough time horizon.
And anything that's selling off you would buy in terms of sectors, or what would you definitely buy? What would you definitely avoid if we do see a 10 to 20% pullback?
So I certainly think being selective around technology makes sense. There are a number of names that are doing quite well. That if we were to see some kind of pullback that creates more attractive valuations, and in particular, I would point to the cybersecurity space as one that is a perennial. Cybersecurity is a perennial concern for CEOs and corporate leaders. We tend to see healthy, robust budgets being afforded to cybersecurity. So I think that's one area with very significant potential if we see a pullback. Others would include some financials. Could really benefit in an environment of rising rates, especially some of the insurance names. So it's really a mixed bag. But I do think that there are those that have really attractive balance sheets and have very solid cash flow, looking attractive except for valuation. So if we see some kind of a repricing, that could spell opportunity.
Okay. All right. I think this is a great time to transition to our rapid fire game of this or that. You've played before. Quick questions, quick answers. Are you ready, Kristina?
I'm ready for you.
All right, here we go. Stocks by year end, higher or lower from here?
Lower.
Buy any dip or raise cash?
Buy on the dip, raise cash when stocks are high.
US or international stocks?
International.
Large caps or small caps?
Large caps.
Defense or offense right now?
A mixture. I can't say enough good things about diversification.
Best sector to play defense with?
I think technology, because of valuations, I think you'd want to be very selective in that space. We're going to see there are going to be winners and losers as a result of the evolving AI CapEx picture. So I think it's selectivity in tech.
Mag 7 or the rest of tech?
Mag 2 or 3 and the rest of tech.
One area of the market you still like at these levels that's not tech?
Well, EM Asia, I really benefiting from the CapEx build out, and for some for Korean stocks, the MSCI Korea forward PE of 7 times.
One trade investors may be getting wrong right now?
I think just the assumption that this will continue indefinitely.
Bonds or cash here?
Cash and some floating rate fixed income.
Biggest risk, geopolitics or weaker consumer?
Geopolitics.
Consumer holding up or cracking?
Unfortunately, the consumer is already cracking to a certain extent. I think that continues further.
Fed more likely to cut or hike rates?
Hike.
Biggest mistake investors make in this environment?
Assuming that what's happened in the recent past is going to continue to happen, not being well diversified, not taking profits and reallocating to ensure diversification.
One word to describe how you're feeling about the market?
Cautious.
And to bring it back to stocks by year end, you said they'll be lower. How much lower?
I think they could easily be 10% lower than where we are here.
All right, we'll leave it there. Kristina Hooper, Chief Market Strategist at Man Group. Thank you so much. Always appreciate your insights, Kristina.
Thank you. I really appreciate being on.
If you enjoyed this Street Talk, check out our full interview with Robert Schein, where he reveals the 4 stocks on his shopping list before the market powers higher. He has an S&P 8,000 price target by year end.